Today on PE Forum, we are pleased to welcome Dr. Stephan Wessel, CEO and Managing Partner of Montana Capital Partners, one of the leading investors in the private equity secondaries market. With a career spanning investment banking, family office investing, controlled buyouts, and global private capital allocation, Stephan brings a uniquely broad perspective on how private markets are evolving. Under his leadership, Montana has developed a strong position in the mid-market secondary space, advising investors through an increasingly complex environment shaped by liquidity demands, geopolitical uncertainties, and changing portfolio construction strategies. In this conversation, we will discuss the evolution of secondaries from a niche liquidity tool into a core private markets allocation, the growing resilience of the lower mid-market, and how investors are rethinking risk, liquidity, and long-term value creation across private equity today. Stephan, thank you so much for joining us today.
Thank you, Khalid, for having me.
So Montana Capital Partner has built a strong position in the mid-market secondary space. How would you describe the firm's core identity today and how it has evolved since its founding?
Well, look, as a firm, we started doing deals at the smaller end of the market, a segment that back then was less frequented than the mid-market, less competed for. And it is fair to say that we were a pioneer and innovator back then in that segment of the market. And we quickly made a name for ourselves with respect to more complex solutions and transactions that were directly sourced, as we refer to it. And directly sourced here means that you engage with counterparties outside of any auction process or intermediate process, which affords you much more proximity to investors, and therefore you have more time to structure transaction and to really listen to and ideally then also implement investor preferences into the transaction structuring. So back then, our first few funds were European focused. We then broadened our scope to include North America, to include emerging markets. We really invested behind a range of strategies initially. So we did anything from VC to buyout investing, including debt and mezzanine strategies. We also used a wide range of instruments from co-investments through structured solutions, NAV facilities, GP restructurings, and so on and so forth. And today, I think, fast forward, that was all 2011 was the founding, over the first 4 or 5 initial years of the company. Today, the secondaries market is much more professionalized. It's more global. So you need a few things in addition to where we started out initially. And sometimes, less is more. So what we very much believe in is a certain degree of also specialization. So take all the things I just mentioned initially. Take the regional focus. We've really refined, refocused that away from more of a global approach to where today we really focus in on North America and Western Europe. In terms of investment strategies, we no longer really invest behind VC, invest behind growth. We are fully focused on buyout strategies. There is less dispersion in returns compared to growth in VC. And frankly, we also prefer underwriting cash flows versus visions and lofty growth aspirations. In terms of the market becoming more professionalized, I think over the past 14, 15 years, we've really found out what we do well and where we consider there to be niches and probably certain, still to this day, inefficiencies in the market. And we'll talk more about that probably later on as we talk about our differentiation. But basically take the direct sourcing element I alluded to earlier. This has now become our partnership approach, and I'll elaborate on what that means. The complexity, the ability to underwrite complex transactions really has resulted in us being very, very methodical in terms of our underwriting, where we combine proprietary in-house models and third-party technology. And the lower end of the market, the small segment of the market, this has now evolved into, on the GP-led side, us being fully focused on low mid-market, ideally specialized managers. So you can see we've come a long way over the past 15 years. We stayed true to, I think, some of those elements, and then also further out refined and hopefully developed, honed other elements of our initial strategy.
You published an LP survey work, which quite impressive, and it highlights from more than, I think, 20,000 data points and 300 billion in private capital allocation. How has this long-term feedback loop basically shaped MSP strategy and product evolution?
Yeah, so I think, first of all, I said it before, we've been doing what we do since 2011. We are quite methodical in our approach. So that means that we have systematically been collecting, analyzing, tracking data, following the partnership with PGIM, which is the large asset management platform with about 1.3, 1.4 trillion of assets. You can imagine that our database has really benefited from this partnership, meaning more scale. PGIM has a globally leading credit business. This credit business basically invests alongside the same GPs that we invest behind on the private equity side. Prudential has a very large general account that has access to hundreds and hundreds of GP relationships. So we also leverage for our underwriting. And then last but not least, PGIM has access to thousands of LP relationships. So we have taken, our data gathering approach, combined it, and we're by no means done, but we're still probably in the midst of amalgamating all the other data points now PGIM provides. Put this together, and this has really helped evolve Montana and our strategy also in many ways, right? We started as a pure LP-led shop. We're now a global firm, if you want to call us that, with about 5.5 billion of asset base. That is pursuing a balanced approach across LP-led and GP-led. And to do that efficiently and effectively, you need access to data, you need access to global scale. And I think those two things indeed we have, and we continue to build those.
And so becoming this global, how important is keeping a Swiss base in shaping your culture and your discipline?
Yeah, it's a good question. And I think it's probably overlooked in many instances. So being headquartered in Switzerland is not incidental for us. It is really embedded in how we think, how we invest, how we build relationships. So if you think about qualities that people, investors associate with Switzerland, such as reliability, trust, long-term orientation, discretion, particular discretion also, these are the same qualities that our investors tell us they value the most in managers. And this resonates particularly strongly with family offices, with foundations, with endowments, with sovereign wealth investors who think in decades, not in quarters, not in years, but really in decades, and who prioritize capital preservation and trust probably as much as they prioritize returns. So it's really helped our approach, and also I think helped our positioning vis-a-vis mostly in today's market, US firms and other European firms.
And your strategy, you do GP-led, you do LP-led secondaries, and you also have bespoke liquidity solutions. What differentiates you from other actors on the market?
Yeah, Khalid, to be very honest with you, this is probably one of the most challenging questions, I think, for every firm, not only secondaries, but also private equity, to answer eloquently. We've given this some thought, and I think I can tell you what has worked well and where we really focus our capital onto. So I think for us, it's three things. It's two elements on the LP-led side. It's one element on the GP-led side. So think back to what I shared about our history, and then I think there's a certain level of consistency here. So the direct sourcing element, the focus on complex transactions, this has now really been evolved to what we call partnership transactions. These are transactions that are very sizable. They happen off market. They happen through multiple encounters and touch points with the same LPs over many, many years to where there is, a certain level of trust. And then at some point in time, these LPs reach out to us and they say, look, we want to sell part of our portfolio, but ideally we'd like to do that in a more, discrete, more bespoke format. And here, the Swiss elements really play in terms of, discretion and the tailor-made, the ability to really customize transactions plays in as well, because oftentimes these sellers seek things over and above just maximizing price. They might not want to crystallize a certain discount at this point in time, so you structure around that, or they might want to retain LPEG seats, might want to retain even a certain degree of ownership in these assets. And this requires a lot of time to really think through and work through. So this is what we call partnership transactions. We have historically deployed about 50% of our LP capital in these type of settings. And they take a long time. So the risk here for us is if they break apart at a certain point in time, then you spend a lot of resources. But in terms of return and risk return in particular profiles, they are very, very attractive. The second element within the LP-led strategy are fund-to-fund transactions. Here, Montana, as you will appreciate, is a pure secondaries firm. So we didn't evolve out of a fund-to-fund context like many other firms in the market, but we have been focused on secondaries and secondaries only. So this means that we are able to transact in so-called fund-to-fund secondaries, whereas other firms that have their own fund-to-fund programs might be restricted from participating in these transactions. Montana is usually a permitted buyer. And this means that we are competing with a limited, much more reduced pool of dedicated buyers. And the second element, and of course, this then translates into pricing inefficiencies and ideally better returns. And the second element is what I said initially about us being very methodical in terms of data gathering, but more importantly, probably data analysis. We believe that we have built one of the most sophisticated tools in pricing broadly diversified transactions. And these two elements, then the limited pool of buyers, the edge through technology, really creates a very clear differentiation. And together with the partnership transactions, we deploy about 80% of our capital into these two things. So fund-to-fund secondaries and partnership transactions. That's the LP-led side. On the GP-led side, it's one thing and one thing only. It's GP-led transactions alongside low mid-market sponsors. Why do we like low mid-market sponsors? We think there is less competition on the low mid-market. We believe that we have, over these past 14, 15 years, in particular now with the help of PGIM, created one of the leading databases really in terms of covering these low mid-market managers, in particular North America, in particular Western Europe. And we typically see a very meaningful return alpha if you compare low mid-market to mid-market, upper mid-market on transactions where companies are being taken from founder-led, family-led through the first wave of institutionalization. This is ideally the type of transactions we like to back.
The secondaries is expanding into new structures such as evergreen vehicles and credit secondaries as well. You've touched a bit upon that. Where do you see Montana focusing its innovation over the next cycle?
Yeah, so I don't think it's going to be as much on the evergreen side. I think for us, if you take a step back and think about our positioning within PGIM, so we are, as we refer to it ourselves, the facilitator. We have the technology. We call the technology secondaries. What PGIM offers is they have asset class expertise. So they are one of the top 3 global credit investors. They're one of the top 3 global real estate and real asset investors. So for us, the growth path here is very much to facilitate, unlock this asset class expertise and pair it with our technology, i.e. secondary. So we've now launched a credit secondaries fund as our second product. You will appreciate I cannot talk about fundraising as part of this podcast, but we are very, very pleased with the progress so far.
The LPs are increasingly moving from being pure capital allocators into also deal makers, with the LPs transaction or what is happening. How is this impacting the structure of the market and even, fundraising cycles?
Yeah, I think on balance, I would think that, and there are very few examples, if we're being honest, where large allocators successfully evolved into deal makers, right? I mean, you have names like, just to call out a few, because I think they've done a superb job, CPP or a handful of sovereigns, right, that really built successful direct deal-making capacities and capabilities. But even with those firms, take the sovereigns, for instance, I believe this can be a net positive for firms like Montana. And in fact, we partner with some of these firms actively as we collaborate on transactions. We very much lean on them for co-investment capital. So I think for us, it's not so much competition as it's really new partners that help us lean into the things we do and provide additional capacity, i.e. capital, to transactions where we basically provide the other side of capacity, meaning strong underwriting and the resources to effectively price these exposures.
I'd like to move on now more on the private equity secondaries and market dynamics. And I will quote you. You mentioned your confidence is strongest in the lower mid market, which you view as better positioned to navigate periods of volatility, which basically we're jumping into now. Can you walk us through what is driving this conviction and what investor maybe underestimate within this segment?
Yeah, so we're big proponents of the low mid market, and we've been big supporters for a long time. And for us, I think it's a number of things, but it's three things at a core, I believe, that underpin our conviction here in the low mid market. If you look at big picture, first of all, the supply demand dynamics, you have by far the largest opportunity set in terms of number of companies. At the same time, you have much lower capital overhang compared to the mid-market or large cap segment of the market. And with capital overhang, what I mean with that is capital raised, so dry powder, compared to capital deployed annually. In the low mid-market, and there's probably a range of figures here that you can quote from, but I would argue it's anywhere between 1.5 to 2.5. In the mid-market, upper mid-market, this capital overhang figure probably extends to up to 4 or 5 times. And interestingly, historically, over the past 5 or 6 years, if you pay close attention to where the majority of capital has been raised, it was raised in the upper mid-market and large cap market. So I think this need, this propensity to at some point, really invest this capital is probably growing strong and strong by the year. Then secondly, let's look at the value creation potential. On the low mid-market side compared to the mid-market, upper mid-market, you have lower leverage levels. You have this ability, what I referred to earlier, to take companies through the first wave of institutionalization. I think few people would argue that probably the highest alpha generation potential is through primary buyout, not through secondary or a tertiary buyout. And you have less formal intermediation, so less professionalization, if you want to call it that. And this results in better entry multiples. And this is something you can benchmark statistically. Last but not least, we're a secondaries investor, and I think this is the key reason why we like the low mid-market. Go back to the capital overhang that I described earlier. The capital overhang in the mid-market, upper mid-market essentially provides our exit route. There is so much capital in that segment of the market, and as I said before, the need to deploy this capital to then, in order to generate fees for the firms, they need to deploy capital, I think is becoming more and more pronounced over the next number of years. And yes, there has been some, slowdowns in terms of deployment, but I think this will break at a certain point in time. I don't know when, but it surely will have to break if you look at the statistical overhang. And then I think, these smaller firms are very well positioned to sell their assets into that big pocket of capital. And that's effectively what we're doing with the GP-led strategy. And take the last 2-3 years of probably subdued exit environment, we continue to sell assets through the GP-led side of our business from the low mid-market to the mid-market to the upper mid-market. And this is why we like it so much.
The secondaries have moved from a niche liquidity tool to really a core allocation for many institutional investors, as you mentioned. In your view, what is driving this shift? Is it more the supply or the demand?
I think it's probably both. Supply is currently, I think it's fair to say supply is currently the dominant driver. And if you want to call it that structural imbalance between record secondary supply and still catching up dedicated capital is really what has made secondaries one of the most attractive strategies probably in private markets today. And if you look at volumes reached in 24, 25, 24, I think we were at 160 billion, 25, we saw record volumes surpass 200 billion for the first time in history. So there's a clear trend here. Overall, dedicated secondaries dry powder now sits at roughly 200, 250 billion maximum. I think it's probably 200 to 220 really, implying a 1 to maybe 1.2, 1.3 times capital overhang or coverage, if you will, of annual deal flow. And this is very attractive, right, compared to the primary buyout segment. And then last but not least, it's the GP-led side. I think this is very much structural. So again, compare this to 5-6 years ago where the GP-led side was maybe 20-25% of the market. Nowadays, it's almost half, in some years even more than half of the market. And I think this instrument, if you want to call it that, is there to stay. So supply is winning, and I think that is the opportunity here.
And where do you see most opportunities? Is it in GP-led or LP-led transaction, or has this classification even become, too simplistic to evaluate the secondary market?
Yeah, simplistic. I mean, maybe I couldn't come up with a better word either, but maybe it's a little bit too simplistic. I think secondaries have become very much an established asset class for active portfolio management, for liquidity, for diversification, right? So it's many elements here. It's certainly not a niche strategy anymore. On the GP-led side, I think complexity is growing, and GPs' motivations range from retaining trophy assets to alleviating fundraising pressure. So you oftentimes see these stable elements in the market. And of course, every transaction has completely different risk-return implications. If you indeed, invest alongside a trophy asset, that's great, but it takes a lot of time to find out, is this indeed a trophy asset? Otherwise, return and quality dispersion is quite wide. On the LP-led side, institutions are seeking liquidity. They are very, very proactively using secondaries as portfolio management tool. I think if you go back to our survey, this has really increased dramatically over the past 2-3 years. So I can tell you that we asked this question, we have been asking it for a number of years. Active portfolio management was always one of many things that larger allocators sought out private equity secondaries for. Today, I think it's the number one tool. So I think at MCP, if you ask me which one do we like more, that's in a way the beauty about our strategy. I understand and I appreciate there's probably two opinions here. There's allocators, there's investors, there's managers that prefer being very clean cut in the sense of either offering GP-led or LP-led. We believe there is a lot of power to offering both, and we call it our relative value approach, right? Where we can really, within our market segment, notably the low mid-market, we feel that we have good oversight of trends, of market asymmetries, and then it's really our job as portfolio manager as well to lean into these pockets of perceived imbalance or inefficiency, and therefore create hopefully attractive risk return outcomes for our investors. So for us, it's both. We like both, and we continue to like both.
The structure of the market with sponsors and so forth have some, analysts say that some deals can be low conviction deals, and this can have an impact in the future. What is your position about that?
No, I think it's valid, and I think that's something that we always discuss at length with our LPs. I think it's indeed our primary mandate on the GP-led side to really cut through all the noise and differentiate and delineate, are these assets indeed trophy assets, or are these assets that the GP wasn't able to sell through an auctioned primary or sponsor process. And this takes a lot of diligence. And I think going back to the data set, it really also takes a lot of time series analysis, because we ideally transact with GPs that we have followed for a long time, where we have tracked the assets, we have tracked developments of the assets. So I think we're in a position to really properly assess, is this indeed a true trophy asset, or is this just maybe a good asset, but one where the GP was maybe a bit too aggressive in terms of underwriting and valuing the asset, and now struggles to sell it off in the primary market.
Stephan, I'm going to ask you now to take out your crystal ball with your 20,000 data points and every information that you have, and tell us, how do you expect the secondary market to evolve within the next 5 to 10 years?
So, crystal ball, I don't have it. I think what's probably fair to say is that it's transitioned already, I think, to a permanent institutional pillar of private markets investing, or infrastructure, if you want to call it that. You have these very, I would even say, structural main drivers. You have the compounding unrealized NAV. I think certain market participants expect this to surpass 20, maybe even 25 trillion by 2030. So these are incredible numbers. You have the normalization of secondaries as a portfolio management tool. You have the growth that we talked about of GP-leds. You have the wealth channel, right? You have the sub-asset class growth that I talked about before across credit, real estate, infrastructure. So I think assume a modest penetration rate. Penetration rate is basically what share of unrealized assets are being transacted on the secondaries market. I think today we're anywhere between 1, maybe 1.5%. So assume very little growth until 2030, assume a 2% penetration rate, and then take the low end of that compounding unrealized NAV. Instead of 20 to 25 trillion, take 20 billion. You pretty much land at secondaries volumes of about 400 billion by 2030. And I think this is probably a base case. It's not even an optimistic case. I think this figure could be higher.
I'd like to move now to your personal career journey and your investment philosophy. So you have a career that spans investment banking, family office investing, and you're now leading a global secondary platform. Fundamentally, what drew you to private equity?
Yeah, for me, just like everything in life, I can give you a few other examples of my career later on. I do believe that a lot of it is also just good fortune and sometimes coincidences. So I interned throughout my last year in college in the US with a private, well, back then it was really venture capital firm. And to be very honest with you, I had no idea what venture capital really was. So my professor recommended me. I had this wonderful opportunity to spend about 20 hours per week for a year with this venture capital firm. And I just really enjoyed what they were doing, digging deep into certain companies, understanding how to help companies grow and become successful. So I asked, the partners at the firm after my internship, what should I do if I one day wanted to do the same thing you guys are doing here? They said, well, first of all, get a proper education, because frankly, after college, I could barely read a balance sheet. So I worked in investment banking for a few years in London. And then I was, again, probably through coincidence, fortunate enough that a large client of the bank that I got to work with asked me to join their investment office. And it was a large family in Europe, and help them build out a direct investment portfolio. And that's what I did for 3 families overall, 3 very entrepreneurial families here in Europe. And for me, that was a great experience, because you were learning from highly successful entrepreneurs and been very close to these companies as they were being built out. And then I had the chance to help one of these families really manage through their direct investment portfolio of about 10 large technology companies in North America and Western Europe. That also provided me the opportunity to maybe broaden my scope from just pure transaction buying, selling to more of a active board role, because I was sitting on the board of all these companies and then guiding each company to exit. So if you will, that was a direct secondaries mandate that I had. And then over the course of 5 years, each of these companies were being exited. And that then brought me to secondaries, because the skill set I think I could contribute, the direct focus on direct private equity is very conducive to our GP-led strategy. And then the overall, I think, threat you see in my career is the building part, the really taking something and trying to make it bigger, build it out. This is very much the fascination here about Montana and all the opportunity we now have with PGIM.
And through these years, is there a pattern that you observed into successful value creation in mid-market companies? A secret recipe, I would say.
Yeah, I don't know if it's secret, but I think that there's a pattern probably that I can refer to. I think, and again, I might be a bit biased here, but I think if you look at the data, the pattern to us, at least as a mid-market firm, is quite clear. You have EBITDA growth, not multiple arbitrage, as a dominant driver. Within EBITDA growth, it's revenue growth. Interestingly, by the way, that is now larger than margin growth. That I think I would argue was different in 2010, 2015. And this is really a meaningful difference, right, compared to large cap investing, where you have leverage and this multiple expansion play. And if you want to look at a few success patterns, I think for low mid-market, there's a lot of buy and build, right? I think buy and build is something that probably requires a lot of scrutiny in today's market. So success patterns here you want to look for are dedicated corporate development teams, programmatic sourcing, real integration playbooks, ERP systems that are being unified. I think the second more exciting, in my experience, pattern is the professionalization. I've now alluded to that a few times, of founder-owned businesses. So you have a few key levers you can pull here. You have the upgrade of the whole, C function, CFO, finance functions in particular. You can install ERP systems. You can build out commercial organizations or also develop pricing capabilities. And I think this is quite interesting, because these founder-led businesses often have a very strong product market fit, but very frequently underdeveloped infrastructure. And this first wave then of professionalization really unlocks comparatively the highest EBITDA improvement. And then last but not least, and very few, I think low mid-market sponsors successfully do this, but the ones that do it are incredibly successful. You have the whole strategic repositioning part. So this is much easier to do for middle market companies, because large cap companies are hugely complex and just very large, by implication. So what you do there is you basically take a product, try to create some form of recurring element around it. You take a company that is a distributor and then move from pure distribution to maybe more of a service installation, maybe even private label type play. You take domestic revenue and internationalize it. You take B2C and layer on top of that B2B or vice versa. So there's a lot of things you can do with these smaller companies that successful experienced investors know how to do. And I think these are probably 3 of a number of patterns that you can probably write a book about.
If we take, investing, the timeline is also very important. And there's a saying today that, family offices present patient capital. And there's this parallel that's been done between, the timeline of family offices and private equity firms. Do you see that, first of all, this is correct, that, family offices have all the time in the world and can be patient indefinitely for a company to succeed? whereas private equity firms have a 5, 7, or 10 years timeline. And where do you see both converging?
Yeah, I think this is probably the key competitive advantage that pension funds, especially the sophisticated pension funds, sovereigns, have over private equity. They have a very flexible long-term capital model. And if they deploy it well, I think this creates competitive advantage quite clearly. And this is also, by the way, if you lean into the positive thesis here, trophy assets, why the GP-led market exists, right? Because certain companies have a lot of runway left, and then these sponsors want to find a way to extend this runway. And that's exactly why GP-led strategies exist in the core sense. So I believe there's a huge advantage. And I think those investors that play it well, and there's a lot of examples here on the sovereign side, on the North American pension side, of firms that do it well. I think there is a competitive advantage, and I think you will see this competitive advantage play out in particular in times of distress. So think back to GFC times, think back to the times of market uncertainty in Europe. That's when these long-term oriented capital allocators can really lean in and create meaningful return differences.
And as a leader managing cross-border teams and investors, what leadership principles matter the most to you?
That's a tough one. I think secondaries and private equity probably in general is a relationship based business. And secondaries, in addition to a primary private equity firm, probably at the same time also an information business at scale. So what that means is you have hundreds of GP relationships. Each one is a source of intelligence on underwriting assets, in terms of providing you with pattern recognition to then compare future transactions against. You have hundreds and hundreds of LP relationships because other than with a traditional private equity firm, these LPs are both sellers and investors to your firm. And that at the same time also creates, in terms of leadership principle, a very high degree of, I think, trust and delicacy here, how to deal with these counterparts, right? Because you sometimes compete with GPs, you sometimes leverage them, and even more so with LPs. And then the second one is probably around the underwriting. So unlike primary private equity, where one company gets deep diligence over weeks and weeks and weeks, we build organizations that must be able to underwrite 100, 150, 200 assets in a very, very short amount of time, sometimes over only a few weeks. And with that, you need data infrastructure to enable your teams to do that. So AI and automation has become increasingly important, not only in today's environment for other firms, but really for secondaries firms in particular. And we've been working on this quite actively over the past number of years. So we're not really caught by surprise here. And then process discipline, standardized work products, right? Team execution that is very, very clear across operations and investment teams. I think getting all of that in order really takes a lot of time and thoughtful process build out.
You mentioned previously to a second order thinking. Could you explain to us what that means in practice when assessing risk, liquidity, and long-term portfolio construction?
Yeah, that was probably people in my team that are a lot smarter than I am that came up with that word. That's a big word. I think for us, it refers to leveraging data-driven insights to understand how investor needs, portfolio exposures, liquidity requirements evolve in the market. And it also means probably asking not just whether an asset looks attractive today, but how it performs under stress across cycles, right? Going back to that long-term perspective that we now talked about a few times. And this is very, very important for us because we build long-term portfolios. And I think the only way to do this if you're being very conscious around diversification needs and controlling single risk exposure. So in a nutshell, I think that is what we mean with that, thinking over and above the obvious, I guess.
Final question. You emphasize data-driven, and you just mentioned AI in supporting your investing approach. So is personal judgment becoming obsolete?
No, not at all. I think data and personal judgments are complements, not substitutes, if you will. I think data for you, and this is something that our CTO always tells us, does not make decisions for you, but it basically raises the quality of investment decisions. And therefore, in a complex secondary portfolio, I think these tools, these AI, if you want to call it that, or analytical tools, our proprietary models that we've really built out now for 13, 14, 15 years, that we've now married with third-party technology. I think what they really do is they help us break down complexity and convert this complexity into actionable insights. I think this is really what it is. So our goal has always been to combine both and have as much high-quality information available as possible. And this is really what MCP has been doing, not only under my leadership, but really over the past 13, 14, 15 years since our founding in 2011.
Stephan, thank you so much for taking the time and receiving PE Forum today.
So much for having me. I appreciate it.